Good morning, I'm Clinton Griffiths. Interest rates are now at the highest point they've been in 22 years. The Federal Reserve setting its benchmark lending rate at 5.5% last week, making it the 11th rate increase since it started fighting inflation back in March of last year. Ag Day's Michelle Rook is here. Michelle, the Fed may not be done yet.
The Fed continues to signal they aren't done raising interest rates yet, especially if energy prices continue to climb. That's proving to be costly for agriculture. And unfortunately, the market experts I talked to say that they don't think interest rates will cool for a while.
Everything in agriculture is more expensive today, from input prices to the cost of borrowing money, which continues to cut into farmers' profits.
And those higher interest rates that are a result of the inflation, that is obviously adding to what farmers have to pay to be borrowing money on their operating notes. So being mindful of that, I think, helps sort of moderate the expectations that even though we're seeing really high commodity prices, that doesn't necessarily mean that we're going to be having rock and roll times in the farm economy.
And even with the historic hike in rates, the Federal Reserve still hasn't reached their target for inflation.
They're not done. I think it was, 8 of the 12 or 9 of the 12 voting members, or it was a high percentage, like 70%. We're looking at least one more rate cut.
A bigger challenge for the Fed moving forward could be if energy prices continue to spike with the rising tensions surrounding the Black Sea War.
Obviously, if this geopolitical situation were to escalate and get out of hand and we start getting an energy component to this crisis like we had a year ago, and how important energy is to headline inflation, they may be forced to do a heck of a lot more than that,
which could further pressure the bottom line for all of agriculture. I'm Michelle Rook reporting for Ag Day.